Dear clients, welcome to Phillip Securities Research Weekly Market Update. I'm Weiwen. Today, I'll be sharing with you the latest on the US fiscal front as well as US macro strategy for 2013. Let's start off with the latest updates on the US fiscal front. US Congress has reached a fiscal compromise, but that is not a grand bargain. Fiscal uncertainty has merely abated for the moment. This exuberance in equity markets yesterday, 2nd January, was largely due to Congress reaching a compromise bill which, amongst other measures, raised taxes on the wealthiest decile of Americans while blocking a tax hike on the middle class and thereby averting an outright recession. Much as we dislike to be party poopers, we caution that the following unresolved issues will return to haunt the US in the next 2 months. First, delayed spending cuts of US $110 billion, as well as second, the need to raise its debt ceiling, which the Republicans will likely use it as a bargaining chip to extract more spending cuts from Democrats. So over the next couple of weeks, we expect bouts of political brinkmanship to continue, and that will rattle markets' nerves. Next, we'll move on to the outlook for the US economy in 2013. On the macroeconomic front, the US is on track for a cyclical recovery, but the pace of economic expansion will be subtrend, weighed down by fiscal withdrawal as well as ongoing deleveraging. Specifically, while the US private sector continues to deleverage, fiscal consolidation is still in its infancy. Housing recovery is going well underway, along with rising consumer confidence, but the labor market still remains the weakest link. Nonetheless, the Fed's recent large-scale asset purchases will ensure financial conditions remain accommodative by supporting the mortgage market as well as maintaining downward pressure on long-term interest rates. What does all this mean for asset strategy? We expect the US Treasury yield curve to bear steepen, with long-term bond yields rising faster. Though the rise in rates for the 10-year and above will be capped by a sluggish US economy owing to fiscal withdrawals and lingering uncertainties on the Eurozone front. Specifically, long-term bond yields will rise along with a pickup in the economy as well as easing of fiscal concerns. By contrast, rates at the short end of the yield curve will be anchored at rather low levels on account of Q eternity, which will likely continue until the labor market improves substantially. Furthermore, with unemployment rate unlikely to come down to 6.5% until 2015, use of short-dated bonds will likely remain depressed for now. Thus, we have low conviction on US Treasuries. There's little upside to Treasuries, which are already highly sensitive to interest rate hikes, translating to a poor reward-to-risk ratio. While high-yield debt should continue to outperform, returns will be significantly lower in view of limited price appreciation. Instead, higher coupons will be the main source of return now. While we maintain overweight on mortgage-backed securities, we wish to point out that there might be limited upside to prices of mortgage-backed securities ETFs, as most of the expectations have already been priced in prior to the September QE3. Furthermore, the Fed does not set the mortgage rate, and instead is just one of the players, although a significant one, in the mortgage market. On balance, low yields in traditional safe havens make fixed income elsewhere, particularly emerging markets, more attractive, especially with risk appetite returning. On account of favorable external balances, monetary policy rates, fiscal stability, foreign exchange rates, as well as yields, we recommend emerging market and Asia local currency bonds. But we caution that our investment thesis and preference for EM Asia local currency debt will weaken if, first, inflationary pressures return, holding hostage emerging markets as well as Asia to higher food as well as crude oil prices owing to supply shocks. As these economies are likely to be weighed down by higher cost pass-through from food as well as oil shocks, real interest rates could actually turn negative easily. Second, capital flight from emerging market Asia debt could occur on the back of global recession owing to policy missteps by the US on its fiscal front. This will particularly be worrying in view of a large share of foreign ownership in a relatively small EM Asia bond market. For US equities, our upgrade from underweight to market weight takes into account the following. First, a resolution to the fiscal uncertainties will provide clarity to assist business investment decisions and restore markets' confidence. Second, a global liquidity glut with G4 central banks in a quantitative easing mode will lend support to equities. Third, improving global macro backdrop, especially with China's emphasis on expansionary fiscal policy as well as prudent monetary policy, will likely continue to support growth in China. Furthermore, we are seeing receding tail risk of a Eurozone breakup, especially of a Greek exit. In terms of currencies, from a medium-term horizon, the US dollar will hold its ground against the euro as well as the Japanese yen. Apart from growth differentials, which favor the US compared to Europe and Japan, Europe is still mired with structural challenges, possibly warranting further monetary easing ahead. On the other hand, Japan will be subjected to downward pressure, with the ruling LDP being vocal about aggressive monetary easing. However, any upside in the US dollar will be tempered by the Fed's Q eternity. Against most Asian currencies, which are supported by excellent macro fundamentals and external balances, we expect the US dollar to come in slightly weaker. That's all for this week. Thank you for watching, and please tune in to next week's Phillip Securities Research Market Watch.